Welcome. Thank you for joining us. We wish everyone well and that everyone is staying safe and healthy. My name is Kris Ferranti. I'm a partner in Shearman and Sterling's real estate group. I'm pleased to be hosting this webinar, Studying the U.S. Student Housing Market. We've planned a thorough and in-depth discussion on student housing investment trends. It's with great pleasure that I introduce our guest speaker, Michael Orsak. Michael has more than 20 years of experience in student housing development, investment, acquisition, asset management, as well as financing. Michael is the Senior Vice President of Investments at Campus Advantage. Campus Advantage is a real estate investment management firm specializing in higher education student housing communities. Since its founding in 2003, Campus Advantage has quickly grown and is now one of the largest student housing and property management companies in the US. Michael is charged with Campus Advantage's investment strategy. This entails the evaluation, analysis, and asset management of potential investments, both real estate and corporate. Michael provides strategic oversight to both the acquisitions and development process, from consideration and evaluation through underwriting, contract negotiations, and due diligence to closing, including securing debt and equity. So Michael, welcome. We're excited to have you join us.
Yeah, thank you for having me, Kris. I appreciate the opportunity to enlighten your clientele on the recession resiliency of the student housing space.
Excellent. So Michael, the questions that I plan to ask will sort of canvass the student housing market trends from immediately before and during the pandemic, and we'll discuss how events have since unfolded and may have shaped and changed student housing investment decisions in the future. Campus Advantage currently manages, develops, consults on student housing communities all over the country. Let's start by talking about which markets in the US you're seeing as the most popular and most successful markets for student housing prior to the pandemic, and then which markets have seen a change either for the better or for the worse as a result of the pandemic.
Yeah, sure, Kris, will do. I think it might make sense for me to set the stage on student housing in the United States. There are approximately 4,300 colleges and universities in the US enrolling over 14 million students. The institutional student housing market is really focused on the top 175 markets, and those are generally referred to as the Axio 175. Axiometrics, a subsidiary of RealPage, is the industry's largest provider of data, and it really has analyzed the 4,300 colleges and universities and really determined which markets are the best for larger institutions to invest in. Those 175 markets account for about 4.5 million students. Universities in those markets house about 21% of their students across the country. That's about 975,000 students. Our focus is on those markets, and within those markets, there's about 800,000 beds that are investable in today's marketplace, and we refer to those beds as purpose-built student housing. So those are communities that were specifically designed and constructed and are currently marketed towards student housing, towards students in those markets. And that market is growing by about 40,000 beds per year. Another good thing to consider when understanding the student housing market is we generally classify universities by tier 1, 2, or 3. And relatively simple concept. Tier 1 are those largest state flagship schools that everybody knows about: University of Texas, University of Alabama, University of Michigan. Think large, big football schools. And then tier 2 schools would be those schools just below that. So instead of a University of Texas, maybe a Texas Tech, Texas State University. And then a tier 3 school would be a school like UNC Wilmington, or perhaps maybe University of South Carolina, Aiken, a school with maybe 5, 7, 8,000 students. The best performing markets prior to the pandemic have really always been those large tier 1 state schools. Those have strong demographics, they have strong consumer demand, and they attract a lot of consumers to go to their schools. Another layer to add on when determining the best markets and identifying those best markets prior to the pandemic were those large tier one schools that overlapped with urban settings. So University of Texas in Austin, or Arizona State in Phoenix, University of Washington in Seattle. So you had the combination of demand drivers, not only from the university setting, but also from the greater metro, driving students to want to go to that school to be in Seattle, right? Or there's not a lot of drive to want to live in Tuscaloosa other than going to the University of Alabama. Those were the best markets prior to the pandemic. And what made those successful for the most part were the ability to really increase their admissions into their schools. So, large state schools with a lot of consumer demand typically have lower acceptance rates. And when they started seeing demand drop off, they were able to increase their acceptance rates.
Got it. Got it. And have you seen a change in those markets, either better or worse, and as a result of the pandemic?
Yeah, yes and no. Those markets, for the most part, performed the best, with the exception of markets that were in heavy lockdown states, or states with are markets with large international student populations. So think California. I mentioned University of Washington, Seattle. That was a market that was heavily hit. And then, you're probably familiar locally with, a lot of the schools in New York. Those were very well occupied, although we don't consider a lot of the schools in the city investable because of the ability to actually get to that real estate. It's very expensive. It's tough to build. But those privately owned student housing beds, as well as those beds owned by universities, performed very well in prior. But with the lockdowns and people trying to flee urban areas, we saw those have some pretty significant declines in occupancy. On top of that, in terms of the tier one schools, heavy lockdowns, international student populations, you also saw a big drop off in occupancy in what I refer to as those tier three schools, and maybe even the smaller tier two schools. Those were schools that were admitting, 85, 90% of everybody that applied previously, and getting very low acceptance rates or admissions rates because, they were a second or a third choice. And so as spaces became available in the tier one schools, those students that applied to a tier three school that might have now been able to go to a tier two or a tier one, there was a trickle up of enrollment in the pandemic.
Got it. Where do you see those markets headed as we pull out of the pandemic? Do we see some sort of recovery to student housing industry in general as we sort of get make our way out of the pandemic?
Yeah, absolutely. The large tier one schools, as I mentioned, continue to perform. We expect those to begin to outperform moving forward. As demand continues to be driven toward, name brand institutions. Things are very bifurcated in the student housing world, and we believe that they will continue to be bifurcated moving forward. Haves and have-nots. Those haves, those large tier one schools, and maybe even the growing tier two schools. The have-nots, those tier three schools, or private liberal arts colleges, which we don't really invest in. But we could see university systems start to withhold funding from smaller schools as their enrollment dropped this year, and move those toward their tier two or tier one schools within that state system, in order to really reallocate funds into more appropriate facilities. So we've seen system consolidation discussions already occurring. University of Wisconsin state system, Pennsylvania state system, both have announced plans to reevaluate the need for a dozen or so branch campuses throughout their state, when some of them are only 50 to 75 miles from each other.
Got it. So, location, obviously important factor in real estate investing. New York City has been a popular location for real estate investment, and it's also a popular location for student education. But with the pandemic hitting New York City and other urban areas very hard, can you dig a little deeper and explain some of the new challenges in terms of student housing you've been seeing in large gateway cities like New York City? You already touched on the point on New York City in particular, hoping you can sort of, dig a little bit more on that.
Yeah, sure. I do think it's going to be a tough road for those large metros in terms of university overlap in the cities. Until broader consumer demand comes back to and is comfortable with living in the city, I expect that those universities within very dense populations to also have reduced enrollments in fall 2021. Although a majority of them are announcing plans to be on campus, I think there will still be a percentage of students that are worried about their health and will decide to forego going to school in the big city and maybe stay a little bit closer to home. I envision with the rollout of the vaccine, hopefully coming to the majority of Americans by the third quarter and maybe even the end of the second quarter, that fall 2022, we'll start to see that demand pick up for those urban areas, and as well as those large metros that were attracting international student populations.
Got it. Great. So the student housing sector has become a very popular asset class over the past several years, with I think what we've seen have been comparatively recession-resistant characteristics. In the past, student housing demand has actually increased during recessions as enrollments swell from students staying in school longer or continuing to graduate school or returning to school to enhance job skills. Have you seen a similar demand this year as a result of the pandemic and the current job market? And I guess why or why not?
Yeah. Yes and no is the answer. We did see graduate student enrollment grow by about 2.7% this year, which we've seen in the past, right? When there's little job prospects for an undergraduate, they may decide to go continue on their graduate studies, right? But we did have undergraduate at four-year public universities, which is our typical target market, decline by about 1.4%. That's not a tragic decline, but it's mostly attributable to about a 13.7% drop in freshman enrollment. So, there's been a lot of talk about gap year freshman class. We expect that freshman class to get back to market this last year, or this next year, I should say. And, would anticipate the overall enrollment growth that we typically see in recessionary periods to pick back up in fall of 2022 and 2021. I mean, the difference between this recessionary period and previous is the physical characteristics of the lockdown, right? And concerns over health, not necessarily job opportunities. So I think that was the major driver in the enrollment decline, especially among that freshman class. In the university markets where we own assets, enrollment actually grew by about 1%. So, it's really, you got to dig into your market and specifically kind of figure out where their demand drivers were. So if those markets were heavily driven by international student population, as I mentioned, those markets probably had a bigger impact to their enrollment this year.
Got it. So the New York Times reported, I think in 2017, that cap rates in student housing sector typically run about 1/2 to 3/4 of a percentage point higher than traditional multifamily properties. How has that assessment held up between the date the article was published in 2017 through March of 2020, and then also through the pandemic in early 2021?
Yeah, excellent question. Cap rates in student housing have actually come down from, when I started in the early 2000s, spread was probably about 100 to 125 basis points. And by year end 2019, the spread was actually 50 basis points. So they'd come down from what you quoted of 1/2 to 3/4 to closer to just 1/2 by the year in 2019. You know, transactional market in student housing was mostly entirely frozen for second and third quarter. In the second and third quarter of 2020, we only saw trades of a total of $300 million versus the average of the last 4 years during that same 2 quarters was about $3 billion. So only 1/10 of the trade velocity during that period of time. So it's really hard to say what overall cap rates have done in 2020 because of the lack of volume. So we only saw about $2.6 billion of trades post pandemic versus an average historical trade annual basis of closer to $5 or $6 billion. So if you look specifically at that $2.6 billion of trades in the fourth quarter post pandemic, the average transactional cap rate was 5.19 versus 5.09. So actually only 10 basis point difference or premium investing in student housing in the fourth quarter of 2020 versus the conventional world. But that was mainly driven by the types of deals that were done in the fourth quarter. So, as everyone was worried about the outcome of student housing, the only properties that really came to the market in the fourth quarter were those that were very well occupied, 97, 98, 99, the top performers in the top markets, and those typically attracted the lowest cap rate. So it was a factor of only the best of the best coming to the market, driving down cap rates, and sort of the rest of the market wasn't in order to have any impact on that weighted average cap rate.
Got it. That makes sense. So shifting gears to financing of student housing deals, what have you been seeing from lenders to student housing deals across 2020? Have things changed as we progressed, through the pandemic into early part of 2021?
Yes, they are they're starting to loosen up a little bit. So, as I mentioned, in terms of the transactional market freezing, that was really debt driven. So, in March and spring break, when university students were told to stay home, don't come back, Freddie Mac, Fannie Mae, the agencies, who typically finance about 75 to 80% of student housing deals on an annual basis, put their pencils down and said, look, we're not going to do any transactions into the fall. And if we do, we're going to provide ourselves some protection. So they started to take debt service reserve on deals, and they also reduced leverage from full leverage being 75% to full leverage being 65%. And in actuality, actually only really offering between 60 and 62% leverage once you factor in the debt service reserves that they were acquiring, both for principal, interest, as well as taxes and insurance, which from our perspective was a relatively knee-jerk reaction. Since then, and as they've seen the resiliency of the space and have been provided data by the industry, both operators as well as the investment sales market, the lending environment has loosened up in the first quarter of this year. We're starting to see a lot of new entrances into the debt space. Some additional life companies, regional banks, even debt funds are starting to fill the gap in student housing. So we believe, as we continue to move forward through the pre-leasing period in student housing, and as we expect to get back to normal on the occupancy side of the equation in the fall of 2021, we believe the debt markets will come back.
Got it. And you mentioned the debt funds. Have you been seeing a demand on the limited partner side, the LP side, or private equity investors in the student housing market?
Yeah, absolutely. I mean, the equity interest has never been greater in student housing. The performance of the asset class has definitely shown its resiliency again in terms of occupancy, rental rate growth. And so we've seen a lot of new interest institutionally in student housing. There's been a large number of international equity, sovereign wealth funds, a lot of Asian capital looking to get in this space, Unfortunately, they're locked out of the market just due to travel restrictions right now, but they're hovering around. And as soon as they're able to get over here and you can really kick the tires, we think we'll see a considerable amount of transactions. When the pandemic first hit, we got calls from private equity groups we had never, ever heard of, really looking for blood in the water. But as we mentioned to them, at the time, our occupancies were set until the fall. And that we believe that it was just the delayed decision process in terms of students making a decision, and we were going to get to near stabilized occupancy. They hovered around and waited to see how things happen, and lo and behold, the student housing industry only lost about 270 basis points year over year in terms of occupancy, fall to fall, from fall of 2019 to fall in 2020. So the large scale distress did not come to fruition in the student housing world. And so, I think a lot of private equity, unfortunately, were licking their chops and then, had to leave the room very hungry.
Right. Got it. What about real property taxes? Has the pandemic affected property taxes at student housing properties in any way, or perhaps it's too early to tell?
That's definitely a concern of ours. At this point in time, it is too early to tell. It's March. Typically speaking, we will start to see 2020 assessments hit our desk over the next 3 to 6 months, usually between March and June. We'll start to see how the assessors looked at 2020 in terms of evaluation year. I'm not so much worried about the assessments. I'm more worried about, tax-strapped jurisdictions hitting tax rates, which unfortunately, I don't think we'll be able to find that out until probably the third or the fourth quarter of the year, once the assessors do their work. But it is definitely something that is on our horizon. I think we're being more conservative on our assumptions as it relates to tax rates moving forward. We do think there will be more than typical tax rate increases. We saw, generally speaking, over the last 5 years, we've actually seen property tax rates decline, with assessments going up, but tax rates decline. But in this case, I think we'll probably see assessments of student housing stay relatively flat, but with the additional operating costs and revenue shortfalls at local jurisdiction, we think tax rates might jump up pretty considerably.
Got it. So Michael, we're about halfway through this school year at this point. So let's talk about what you have been seeing so far during the school year. How has housing been operating during this past fall semester? Did you experience any surprises?
Yeah, on a financial perspective, student housing performed very well this fall. As I mentioned, the industry as a whole only lost about 270 basis points in occupancy. It did dip below on an aggregate level, below 90% this year, at 89% on average. So, first off year without a 9 handle in occupancy for student housing, but in the face of a pandemic, when in March everyone thought the sky was going to fall and we were going to be left with 50% occupied properties, the student housing industry believes we performed very well. Our owned asset portfolio, we only lost about 200 basis points in occupancy, but at the same time, we were able to grow rents by 2%. So net neutral top line for us, that feels pretty good. That to Campus Advantage and to most of our investment base feels as though they invested in the right asset class and being resilient. The biggest impact to student housing was really in March through June. When kids were sent home and told not to come back to the local markets, we had to really rewrite our whole playbook on marketing and leasing, as well as how to actually operate the sticks and bricks of our on-site communities. So we went to a rotational staffing plan for a large number of our properties, such that we had half the properties work one day, or half the staff work one day and half the staff work the next day, so that if someone did encounter COVID exposure, it wouldn't take down the whole staff. And then on the marketing and leasing side, student housing's always been word of mouth. But when kids get sent home, there's no mouths or ears in the market to tell the story, right? Guerrilla marketing has typically been a large focus for us, as well as social events, right, for marketing efforts. But we were able to entirely shift our marketing and leasing and sales approach to a virtual one, really because of our vertical integration. So we own a marketing company called Catalyst that sits in the same offices as we do. And in mid-March, when we came back from spring break, we sat down with them and we said, we got to rewrite our playbook. And so we readapted, revisited all of our websites, revisited all of our web marketing. We utilized the studio here to start doing some, some additional leasing, as well as, on-site staff. We implemented virtual leasing tours, both canned and live. So if someone wanted to have a leasing tour, we were actually walking around with iPads and iPhones, taking tours of our properties starting in April, which is not something that we had done in the past. Right. Since October, when we moved everybody in, I would say it's mostly back to normal. Our marketing leasing is still 90% online, although we do have students, living on our properties, as I mentioned. But with social distancing requirements, we're not able to go on campus, hand out flyers. We're not able to have large social events to attract potential tenants. So, marketing leasing is still very much online. Spring semester so far has been very positive for the industry. As a whole, the industry put on about 70 basis points of occupancy from December to January, which in my 20-year career in student housing is the first. Generally speaking, the industry loses about 50 to 70 basis points between December and January through December expirations for graduating seniors. In the industry usually allows renewals that'll be graduating in December to sign short-term leases, although the rest of the property might be on a 12-month lease. We provide that flexibility to our residents that are graduating not to have to sign a lease that they don't need. So we believe this is some really good silver lining for fall 2021. It shows that students want to be back in the market. They intentionally went out and signed leases to be in the school as their school started to open up, because we did see classes. Most universities are offering more classes in person in the spring than they did in the fall. And at this point, a majority of schools are starting to evaluate their planning process. And we've seen some large state systems actually already make announcements that they will be in person in the fall, such as the Cal State University system, as well as the SUNY system locally for you, are all mostly planning in-person classes in the fall.
Got it. That's helpful. That, covers a lot of on the occupancy rates, which no doubt, as you mentioned, impacted by remote classes, but it seems like there's been sort of an uptick more recently, which is unique from past years. But have you been seeing any, any trends, for example, with students opting to stay at home to minimize costs, or have you been seeing students opting to remain at home, but getting housing in places other than where their schools are located? Any trends like that you think might have an impact on future occupancy levels?
This year, as I mentioned, the 270 basis point decline in occupancy year over year, that likely accounts for those students deciding to stay at home. Majority of the markets that had the biggest occupancy declines weren't the traditional land grant schools. It was the schools that I talked to you about that were in large metros, and by and large schools that were transitioning from commuter campuses to traditional campuses. So a lot of the Cal State system, right? Those were traditional commuter campuses. People drive in to school every day and drive home. They might only live 5 minutes, but if you're in California, it might take you 45 minutes to an hour to drive those 5 miles. So we saw in Cal State system schools, they've had their purpose-built student housing supply has really been only added in the last 5 years. And as those students that were impacted, both financially as well as from a lockdown perspective, they decided that there was no need to spend $800, $900, maybe even $1,000 to live next to campus anymore, because there was no need to go to campus. So they kind of stayed home. you pose an interesting question about students not wanting to stay home but not going to school. I did see one article about a group of 20-something that attempted to create their own little college campus. I think it was in Kansas, and they master leased a limited service hotel, and were trying to market it as a place for students to go to be together, but yet be socially distanced and not be in their college town. But I haven't seen that broadly, to be honest with you.
Got it. So socioeconomic data must have some impact on occupancy levels. Are you seeing different trends in terms of decisions to obtain student housing versus staying at home due to remote school options that are based on students who are receiving higher percentage of Pell Grants or government aid, or taking out maybe higher levels of student loans in comparison to students who are not receiving these types of financial aid?
Yeah, very, very, very interesting question. One that we are going to answer in our next annual market analysis. So every year we slice and dice the strengths of university markets based on a number of factors, both on the supply side, on the demand side, as well as the socioeconomic characteristics of the students in terms of their ability to afford purpose-built student housing. Haven't gone through that cycle yet. A lot of universities are slow to provide their data for fall of 2020. And so we expect to be able to answer that question with real data probably in the next 3 to 6 months. If I were to guess, I would imagine, as I mentioned, that there's a rather large drop in freshman enrollment this year. I'd imagine a majority of that was first generation college students. Typically speaking, those come from lower income brackets. The majority of the job losses we saw in the economy this year were, service industry jobs, folks working, a couple of jobs. Those are generally speaking where those students are coming from, those types of families. So I have to imagine that's where those are concentrated. But if we look at, how properties perform based on distance to campus, and you can generally characterize student housing by either being walkable, bikeable, or you have to take a shuttle, right? Generally speaking, we always see pedestrian to campus properties performing notably better than their bikeable or drive to campus counterparts. But this year there was no discernible difference between the occupancy rates or the rental rate rates for those different asset classes within a market. And generally speaking, the furthest from campus are the cheapest price point. Those would be the ones that would be filled by first generation, or those individuals that are on the lower socioeconomic side of the spectrum. So that leads me to believe that there wasn't a large difference. So I guess the question is maybe at this point, but love to get back with you on the answers once we get the data.
Yeah, that makes sense. So Michael, in terms of a vaccine, most students are likely in the bracket of people who are to receive the vaccine last. How long do you think the impact of the pandemic will remain on the student housing market? Do you think when the vaccine is finally available to people in that last bracket, things will change?
As it relates to colleges and universities across the country, I think the biggest factor to getting back to normal is going to get those professors and university staff vaccinated. My understanding is they are, depending on the state, phase 1C, typically educators are in 1C, and phase 2. I know, just being in the state of Texas right now, that most of the phase 1, 1A and 1B are being rolled out, and we're actually starting to allow kind of non-phase 1 individuals to get vaccines. So I believe as long as those professors and those university staff, which were really worried about their health because they're in that age demographic, right, that typically saw larger impacts to their health with COVID, if we get those individuals vaccinated, by and large, the student demographic as illustrated by the occupancies across the country, they're not as concerned, unfortunately, with COVID and the impacts that that it may or may not have on their body. I think they look at the demographics and say, if I get it, I'm going to have a little cold, or I'm going to be asymptomatic. So that's not really driving students away. It's more the the faculty and staff. Their concerns over their health, which is what put everything in virtual. And if we can get those individuals vaccinated, we'll be back in class in the fall.
Got it. So what about travel restrictions? Have you seen trends of less international students coming to the U.S.? And if so, how has that impacted occupancy rates and the overall student housing market?
Yeah, absolutely. International student enrollment is down. It's down about 8% at the graduate level, about 14% at the undergraduate level. To frame that, there's about 1 million international students. So, somewhere about 100 to 150,000 student drop in international students in the U.S. is what those numbers would indicate. We don't expect international student populations to bounce back in the fall of 2021. Across the world, COVID-19 is still having very large impacts to U.S. embassies. There are two very large international student referral companies that the student housing industry has had speak to us every other week for the last 6 weeks, and have another update from them next week. And the last update we got from them 2 weeks ago was that, specifically in China, which drives a lot of demand, there's something like 6 main embassies that you go to for visas, only 1 was open. So, until internationally we get COVID-19 controlled and embassies open up, I think there will continue to be some international student enrollment, either flat or potentially declining until we get the pandemic in control across the globe. I will say that there's about 350,000 U.S. students that typically study abroad. That this year didn't, and I don't think universities will kick off their study abroad programs for fall 2021 because of the global pandemic. Although we might have it under control here, it's not necessarily under control elsewhere. So I think a net positive in terms of students coming here or our students going abroad. But I in terms of getting back to fall 2019 levels, which were an all-time high, I don't see that until fall 2022.
Got it. Yeah, that makes sense. So I understand marketing student housing communities to young professionals has in the past been an option to obtain higher occupancy once the traditional leasing season ends. Does seeking out young professionals to obtain higher occupancy become more important today? What have you been seeing as the trends in terms of housing for young professionals?
Yeah, that's an interesting question. I think you do see this trend in large metros such as New York, Chicago, LA, some Seattle. Generally speaking, in land grant institutions in the Southeast, we haven't seen that trend across the board. What we have seen across the board in our industry is when we do have vacancies, we tend to convert those units to short-term rentals because they are already fully furnished apartments, right? They're typically speaking, they're 4-bedroom, 4-bath, fully furnished apartments. Oftentimes granite countertops, stainless steel appliances. So we go out and acquire utensil packages and toaster ovens, things like that, and it allows us to boost income in the fall semester. Generally speaking, there's a lot of demand for short-term rentals around the football season. We've had a number of universities not only announce that they plan to be in person in the fall, but they also plan to have football back in 2021. So we are absolutely setting the stage to if we do have any occupancies or vacancies, I should say, in our portfolio, we'll have short-term rentals ready to kind of fill that gap in terms of revenue.
Got it. Michael, have you been seeing any pandemic influenced strategies or ideas to add value to student housing? Initiatives like increasing bathrooms to achieve bed bath parity, or larger clubhouses, study spaces, fitness centers to allow students to maintain social lives to an extent while social distancing and improve mind and body wellness. Have those become more important? I also imagine, increasing Wi-Fi, IT infrastructure, for example, to accommodate remote classes and other remote activities have also become more important. If you could speak to that.
Yeah, sure. As it relates to value add opportunities from the investment perspective, given the sort of the shutdown on the debt markets, hard to see that actually being effectuated post pandemic. Through year end 2020, we have seen value add opportunities come to light here in the first quarter of this year, and we're chasing a couple ourselves. They're more occupancy plays than capital improvement plays. Most student housing is believe it or not, really already COVID compliant. The majority of those 800,000 beds or so in our investable markets across the country do contain bed to bath parity. They're 4-bedroom, 4-bath, 3-bedroom, 3-bath, 2-bedroom, 2-bath apartments. And many already include private study spaces. In fact, we delivered a project in Gainesville, Florida this year in the fall, and we have 12 different study spaces scattered throughout the property. That's twice as many as the average delivery the year before. So the student housing space was already moving toward, providing that space for students to get away from their roommates and to provide them that private study space. We have seen some student housing operators focus on adding baths to properties that don't have parity. And that's always been a very good value add play in student housing. Wi-Fi, definitely something that the student housing industry keeps up with. I think our average time to refresh our equipment is about every 3 years. And we generally have annual increases to our bandwidth already factored into our contract. Actually, I took a look at our internet satisfaction for this fall versus the previous fall, and no noticeable drop off. So looks like we were already prepared for the pandemic. As I mentioned, the majority of these 800,000 beds were designed specifically for student housing, and we were already seeing some virtual learning, more additions to the curriculum in a lot of markets. So we were prepared as it relates to our internet infrastructure. But that is something that we focus on when we invest in an asset in student housing. That's almost always part of the capital plan, is improving the Wi-Fi and being prepared for the next 3 years.
Got it. And so, Michael, in terms of social distancing requirements, was there not much of a need for more rooms because of social distancing? I noticed NYU had rented out significant number of hotel rooms near Washington Square Park to accommodate some of the social distancing needs. Are other schools using those types of tactics, or has there not really been that big of a need for many of the communities Campus Advantage has?
Yeah, definitely. Well, there was what's called a de-densification process. So most campuses whose housing stock consists of, really residence halls that were constructed during to house the baby boomers, 30, 40 years ago, which were designed to have shared bedroom accommodations, sometimes up to 3 or maybe even 4 individuals. sharing a 150 to 200 square foot space. Absolutely, we saw universities across the country reduce that densification, limiting the number of students that lived or shared a bedroom. Definitely, I don't know of any school that still had 4 kids living in the same room. And we also had universities shut down entire residence halls where they had community bathrooms. So, a dozen or so suites sharing, one large bathroom accommodation. Those were mostly entirely shut down. And those universities reached out both to the hotel industry as there was large vacancies, and also to the student housing industry. In fact, the student housing industry actually came together and created a database that was called the Bridge Project that showed all of our host institutions the vacancies that are available in the market on a weekly basis in terms of being able to accommodate students that they needed to move off campus. And a few master leases were signed. But by and large, because of the resiliency of the off-campus market and demand there, we didn't have the beds to provide those universities. So they reached out to the hotel operators. We're actually looking at a few hotel conversions ourselves for student housing. There's a large number of limited service hotels that make their living around the fall football season, which had really crippled a lot of those private owners this last fall. So we're starting to see a lot of opportunities to convert limited service hotels that are walkable to stadiums, and we're evaluating a few of those ourselves.
Got it. So sort of the flip side of this, in terms of maintaining, a social environment for these students during COVID, what have you been seeing student living communities do to maintain that environment, ensure that students have opportunities to remain social, albeit, from different rooms, and maintaining social distancing? Examples I've seen included, virtual movie viewing parties or gaming tournaments, online group fitness programs, virtual study groups, things like that. Curious to see what programs you've seen implemented.
Yeah, absolutely. This is really our bread and butter. Campus Advantage was founded with the intention to provide superior customer service through residence life programming. Our 3 founders were all resident directors on campus and worked for a company called Allen and O'Hare, which was really the original off-campus purpose-built student housing provider, and they had a very large focus on residence life programming. So that's really always been our secret sauce. That's what sets us apart from our competitors, is our residence life program. We really try to mirror what the students can get on campus, off campus. So COVID really changed much of what we do. But in some ways it helped us, embrace those trends that we were already seeing and really pushing them forward, right? So we were already starting to have more virtual type events, but removing those in-person events, it was a big change for us. It was a challenge. We were unsure whether or not we were going to get the engagement. And obviously to us, it felt like there was a glaring hole in the experience that we continue to try to provide to our residents. So, we shifted to additional online portals, encouraging online engagement. And as you mentioned, on virtual movies, virtual study groups, online fitness groups. We really leaned into social media. We've seen a lot more opportunities being able to engage with residents, in Instagram and TikToks, from doing contests to create more engagement around our properties, or even sharing educational information. We place a greater emphasis on engagement via these tools. And then, as you mentioned, virtual events. We've done virtual events from painting events where we drop off supplies at people's doors, and then our cooking events where we have raw ingredients delivered, to video game events. So we've definitely tried to provide as much experience as we can to our residents during this time, because that's our focus. That's what we like to do, and we love to do it. And we continue to see strong adoption of our career success portal. So we're one of the few companies in student housing that provides all of our residents access to a career success portal that allows them to have interactive workshops. It helps them build resumes. There's also mock video interview practicing, as well as a job posting that provides a first look at available job opportunities and internships across the country.
Got it. Got it. So Mikey, you touched on this a little bit earlier on, but in terms of marketing student housing to students, with students traveling under normal circumstances from all over the world to 10 schools in the U.S. and even students traveling from different states, how important is it now to have virtual means of showing housing options to students?
Yeah, as I mentioned after March 13th, it became absolutely necessary. And if you weren't able to really flip that switch from the old school guerrilla marketing, handing out flyers on campus at your comps, to being able to deliver that sales approach online, you were not successful. For probably 3 months, we weren't performing any in-person leasing tours. All of our tours across the country within probably 2 weeks had canned online leasing tours. And then we had the ability to set appointments where we would provide personalized virtual tours via leasing with a leasing agent via an iPad. Additionally, we increased our web advertising spending by approximately twofold in the last 12 months in order to drive additional traffic to our website, since we weren't getting traffic in our doors. Those tours provide a great value for parents. They're part of the decision-making process of where these students live. A lot of students, except for the freshmen who this year, may be virtually learning at home rather than in market, already sort of know which properties they do or don't want to live in, next year as they go around and visit their friends. But without virtual tours and specifically those personalized tours, those were very important for closing. I don't think that the student housing industry would be as successful in its occupancy performance this year if we weren't able to change overnight.
Got it. And do you think the virtual tours are here to stay even beyond a post pandemic, or do students still value the ability to tour housing options in person, or maybe you'll have sort of a mix of both?
Yeah, I think we will have a mix. I think a lot of parents might utilize the virtual tours on a go-forward basis more so than students will. Students, I think, other than freshmen, although I would say freshmen, generally speaking, across the country, as universities house about 21% of their enrollment on campus, freshmen generally live on campus. So there's not really much decision making there. And then, as I mentioned, over that freshman year, they get to know the local market. So I think these virtual tours will be very important for parents, rather than having to go, to visit Johnny over some weekend in the fall and spend all day touring the market. Maybe they just say, okay, send me a link to your top 2 choices. I'll make an appointment. I'll do a virtual tour. And, instead of spending my weekend with you touring a bunch of properties, I'll spend my weekend with you catching up, right? I also see the virtual tours being very important to international students being able to decide where they want to live. In fact, the existence of these virtual tours may in fact drive down the need for the student referral companies.
Got it. So Michael, at some point, as you know, investors are likely to exit and cash out on their investments. So it's important to know when it is time to sell a student housing community. In the past, I believe Campus Advantage identified 3 critical factors to consistently identify the right time to sell. 1 being staying true to your original investment thesis. 2 being evaluating local market supply demand fundamentals with a 2 to 3 year outlook, and then completing annual reviews of financial performance. Do you still, recommend applying these three factors today with the financial strains of the pandemic, or would you add or change anything about these suggestions for the current circumstances?
Yeah, I think staying true to your original investment thesis, understanding the local supply and demand fundamentals, reviewing your relative performance to your peers are still factors in determining when you should sell a property, or maybe when you should do a secondary value add um, enhancement if you decide to own the property for further, if you see some tailwinds in the market moving forward, but maybe you just lost a couple of positions due to a need to refresh your asset. The biggest factor to whether or not you're going to be able to effectuate your decision is really the short-term dislocation in the debt markets. So as I mentioned, only the best of the best were transacting in the fourth quarter. So only if you were, above stabilized occupancy, 95% or above. So what this might do is put a little bit of a pause to when you might be able to effectuate. So if you wanted to sell in fall 2020, but you were only, 92, 93% occupied, you'll probably need to wait until this fall. And hopefully, the market, both from an occupancy perspective, will be back up those couple hundred basis points, as well as the debt market will be, more active in order to get the cap rate that your property deserves.
Got it. Would you characterize now as sort of a buyer's market or a seller's market? And do you see that changing soon?
Yeah, right now I would say it's a seller's market for core pedestrian to campus assets. So if you own an asset walkable to campus, 95% of lease or above, built within the last 5 years, those deals are trading at cap rates lower than we've ever seen. If you sell, as I mentioned, a bikeable, if you own a bikeable asset or a shuttle to campus asset, those are buyers markets. So you're not going to want to sell that property right now because you're not going to achieve top pricing. In fact, you're going to probably achieve a cap rate that's probably 25 basis points lower than what you could have got in fall of 2019. So unless you're under some sort of stress, it's probably not the right time for you to be a seller of that property. But if you're a buyer of that investment thesis, which we are, we believe the most accretive returns in student housing are what we would generally refer to as core plus student housing opportunities. Those that are bikeable to campus, have a strong market position, but not the top of the market. As I mentioned, affordability is a factor in our investment thesis as well. So we generally play in that down the middle of the fairway market, and it's a buyer's market, but not a seller's market for that middle of the fairway. So we're looking for opportunities to execute, and waiting for the debt markets to come back on those down the middle of the fairway opportunities. As it relates to normalization, I do see 2021's volume picking back up. 2020 ended up with about $4.5 billion in transactions, and that was really about 50% in Q1, 50% in Q4, based on the deals that came across our desk in Q4 that would typically trade in Q1. We see Q1 being about a $2 billion year. If we could keep that up, I think we'll end up in about a $6 billion range. So not the $8 billion peak we were in 2018, but much better than the $4.5 billion in 2020. And I see a full return to normal in 2022, as I believe occupancies will be back to normal this fall. And as the debt market sees that in the data, I believe they'll come back fully.
Great. So Michael, last question. Are you optimistic about student housing for the long-term future?
I am. We have some considerable tailwinds for the industry, at least over the next 5 years. There's on the demographic side of things, 18 to 21-year-olds, that age group is the population is going to grow over the next 5 years. As I mentioned, the gap year freshman students, are going to come into, we believe, are going to come into the fold in 2021. So that'll put some additional demand into the equation. So we think things are going to look pretty good over the next 4 to 5 years for student housing. And on the supply side, at least the next 2 years are about 25% off their normal in terms of supply deliveries. And so that's good. So we think there's a lot of strong tailwinds, at least in the midterm for the industry. And given the fact that, I've been in the industry for 20 years, I don't want to be in the industry for another 20 years. I'd rather retire in 10. But I think the industry looks good for the next 5 to 10 years.
Excellent. Thank you, Michael. I want to thank everyone for joining. I also want to thank our guest speaker, Michael Orsak, for his invaluable insights. We wish everyone well during these difficult times. We hope you and your families are staying safe and healthy, and we look forward to seeing you all again.
Yeah, thank you, Kris, and everyone stay safe and healthy.
Thank you, Michael.